$2.1 trillion. Let that number sink in. It is larger than the entire economy of many powerful nations. It is a sum so massive that a small shift can move global markets. And this exact amount has been linked to one name that already controls more money than any institution on Earth: BlackRock. Over the past few weeks, a quiet but serious shift has taken place. Headlines spread fast, social media exploded with claims. Some said BlackRock was pulling money out of America. Others called it a warning sign. A few even called it the beginning of something much bigger. But very few explained what actually happened. And almost no one explained why it matters to regular people. This video is not about panic. It is about clarity. Because behind the dramatic headlines is a deeper story that most people miss. A story about risk, power, global money flows, and how decisions made in private boardrooms can slowly affect jobs, savings, retirement accounts, and even the cost of living. Here is the part that rarely gets discussed. BlackRock does not just react to markets, it helps shape them. When the largest asset manager on the planet changes direction, other institutions pay attention, governments pay attention, markets adjust quietly before the public even notices. That is why this move matters. In this video, you will learn what the $2.1 trillion shift really means. Not the rumor version, not the fear-driven version, the real one. You will understand where the money actually went, why certain American assets suddenly became less attractive to the world's biggest investors, and why this shift is happening now, not 5 years ago and not 5 years from now. You will also learn something most channels never explain: how asset managers think differently than governments, why reducing exposure does not mean abandoning a country, and how global diversification can be a signal of opportunity rather than collapse. Most importantly, you will learn how this affects you personally, whether you invest or not, whether you follow markets or ignore them, because these decisions influence interest rates, stock prices, retirement funds, and even how stable the financial system feels in everyday life. By the end of this video, you will see past the noise. You will understand the strategy behind the move. You will know which claims are exaggerated and which concerns deserve attention, and you will walk away better informed than most people reading the headlines right now. So stay with us until the end. The final insight may change how you see global money forever. Welcome to the channel, where we break down complex financial moves in clear and simple language. If you value calm analysis over loud fear, make sure to subscribe and turn on notifications. New videos like this are coming, and you will not want to miss what comes next. BlackRock is not just another investment firm. It is the largest asset manager in the world. It oversees more money than the combined economies of many countries. Governments, pension funds, insurance companies, universities, and millions of everyday workers all have money managed through BlackRock in some form. When people hear its name, they often assume it owns this money. That is not true. BlackRock does not own most of the assets it manages. It acts as a steward. The money belongs to clients. BlackRock's role is to allocate it, protect it, and grow it based on agreed strategies. This distinction matters more than most people realize. When headlines say BlackRock moved trillions of dollars, many assume the company made a single decision with its own cash. In reality, these shifts reflect changing preferences across thousands of funds and clients responding to economic conditions. The company adjusts portfolios based on risk models, forecasts, and long-term trends. These adjustments often happen quietly and gradually. The recent rumors began when analysts noticed large reallocations inside BlackRock-managed funds. Reports showed reduced exposure to certain United States assets, especially long-term government bonds. From there, the narrative grew. Social media simplified the story into something dramatic. BlackRock is fleeing America. Money is leaving the country. A collapse must be coming. These claims spread fast because they tap into existing fear about inflation, debt, and economic uncertainty. But the reality is more complex and far less dramatic. BlackRock did not pull all its money out of the United States. It did not abandon American markets. It did not make a single sweeping exit. What happened instead was a strategic rebalancing. Certain positions were reduced, others were increased, some capital was shifted across borders. This is normal behavior for large asset managers, especially during periods of economic transition. A major focus of the adjustment involved long-term United States government bonds. For decades, these bonds were seen as one of the safest assets in the world. They offered stability, predictable returns, and global trust. But conditions have changed. Interest rates rose rapidly after years of being near zero. Inflation surged and then cooled unevenly. Bond prices fell as yields rose, creating losses for holders of long-duration debt. For a firm like BlackRock, holding too much exposure to long-term bonds during such shifts increases risk. Even assets considered safe can become volatile when rates move quickly. Reducing exposure does not signal distrust in the United States. It reflects risk management in response to changing monetary conditions. At the same time, BlackRock increased allocations to other areas. Private markets became more attractive. Infrastructure projects offered stable cash flows tied to real assets. Private credit provided higher yields than public bonds. Technology investments aligned with long-term growth themes such as artificial intelligence, energy transition, and automation. International markets also gained attention, especially regions with younger populations, lower debt levels, and faster projected growth. This diversification strategy follows a simple principle. Do not rely too heavily on one country, one asset class, or one economic outcome. When the global economy enters a period of uncertainty, spreading exposure becomes essential. For asset managers responsible for retirement savings and institutional capital, avoiding concentration risk is a priority. Another factor driving the shift is the scale of United States government debt. The national debt has grown to levels never seen before. Trillions of dollars are added regularly through deficits and refinancing. Servicing this debt becomes more expensive when interest rates rise. This increases pressure on fiscal policy and can influence future tax decisions, spending cuts, or monetary responses. Large investors pay close attention to these dynamics. Rising debt does not mean default is imminent. The United States still has immense economic power, but it does change the risk profile of long-term bonds. When debt grows faster than economic output, future policy choices become more constrained. This uncertainty can make long-duration assets less attractive relative to alternatives. Inflation also plays a role. Even moderate inflation erodes the real value of fixed income returns. Investors lending money for 10 or 20 years want confidence that their purchasing power will be preserved. When inflation expectations rise, investors demand higher yields or reduce exposure. Asset managers adjust accordingly. Global diversification offers ways to balance these risks. Some economies have lower debt burdens. Others are earlier in their growth cycles. Emerging markets, while riskier, offer higher potential returns. Developed markets outside the United States provide currency diversification and exposure to different policy environments. Shifting capital across regions allows portfolios to absorb shocks more effectively. Private markets add another layer of flexibility. Unlike public bonds and stocks, private assets are less sensitive to daily market swings. Infrastructure projects often involve long-term contracts tied to essential services such as energy, transportation, and communications. These assets generate steady income streams that can perform well even when public markets fluctuate. Private credit has grown rapidly for similar reasons. As banks face stricter regulations, non-bank lenders fill the gap. These loans often carry higher interest rates and stronger protections for lenders. For asset managers, private credit offers yield without relying solely on public debt markets. Technology investments reflect long-term structural shifts. Automation, data processing, artificial intelligence, and digital infrastructure continue to reshape economies. Capital flows toward areas expected to drive productivity and growth over decades, not quarters. Allocating more funds to these sectors aligns portfolios with future trends rather than past assumptions. International investments also help manage geopolitical risk. Tensions between major powers, trade disputes, and regional conflicts create uncertainty. By spreading assets across multiple jurisdictions, investors reduce exposure to any single political outcome. This approach does not signal distrust in one country. It reflects a preference for balance. Another lesser discussed factor is currency exposure. Holding assets denominated in different currencies can protect portfolios from exchange rate volatility. When one currency weakens, others may strengthen. Large asset managers consider currency risk as carefully as interest rate risk. The scale of BlackRock magnifies the visibility of these shifts. Smaller firms make similar adjustments without attracting attention. When trillions are involved, even routine rebalancing looks dramatic from the outside. Headlines focus on the number, not the process behind it. The rumor of fleeing America also ignores the fact that BlackRock continues to manage enormous amounts of United States assets. American stocks, real estate, private companies, and infrastructure remain core components of its portfolios. The firm operates deeply within the United States economy and benefits from its innovation, markets, and institutions. What has changed is emphasis, not allegiance. Weighting matters more than presence. Reducing one asset class while increasing another reflects changing expectations, not abandonment. This process is continuous. Asset managers constantly reassess assumptions about growth, inflation, interest rates, technology, demographics, and policy. Models are updated, scenarios are tested, allocations shift gradually. The public often sees only the result, not the reasoning. Understanding this context helps cut through fear-driven narratives. Money does not move based on emotion at this scale. It moves based on data, incentives, and long-term strategy. Large institutions aim to survive across decades, not chase short-term headlines. These reallocations also highlight how interconnected global finance has become. Capital flows freely across borders in search of stability and return. No single country exists in isolation. Decisions made in one market ripple through others. As conditions evolve, so do strategies. Rising interest rates change bond dynamics. Technological advances create new opportunities. Demographic trends shift consumption patterns. Energy transitions reshape infrastructure needs. Asset managers respond by positioning portfolios to reflect these realities. None of this happens overnight, and none of it signals a single verdict on the future of the United States. It reflects adaptation in a changing world. When people hear numbers measured in trillions, logic often shuts down. The human brain is not built to process figures of that scale calmly. $2.1 trillion does not feel real, so it immediately feels threatening. The size alone creates emotional reactions before facts have a chance to settle in. This is why stories involving massive sums spread so quickly. Fear travels faster than explanation. Online platforms amplify this effect. A dramatic headline performs better than a careful breakdown. Short clips strip away context. A single sentence gets repeated thousands of times without clarification. Very few posts explain how asset allocation works or why large firms constantly rebalance portfolios. Instead, complex financial adjustments get compressed into simple narratives that sound alarming. Money is leaving. America is losing trust. Something big is about to break. Another reason people misinterpret these moves is that most media outlets do not explain the difference between ownership and management. When people hear that BlackRock moved money, they assume BlackRock personally controls and owns those funds. In reality, asset managers act on behalf of clients with very different goals. Pension funds seek stability. Insurance companies focus on long-term liabilities. Endowments plan for decades. Each has different risk limits and return expectations. Portfolio changes reflect this diversity, not a single decision driven by fear. There is also confusion around the idea of underweighting. Reducing exposure to one asset class does not mean rejecting it entirely. It means adjusting proportions. A portfolio can still hold large amounts of United States assets while holding slightly less than before. This distinction rarely appears in viral content. Instead, nuanced strategy gets reframed as abandonment. Another overlooked factor is timing. Asset managers often make adjustments months before the public hears about them. Regulatory filings, internal rebalancing, and gradual shifts take time. By the time headlines appear, the move may already be old news within financial circles. But to the public, it feels sudden and urgent, creating the illusion of a rapid escape. Fear-based narratives also thrive during periods of uncertainty. Inflation, rising interest rates, geopolitical tensions, and political division all create a sense that systems are fragile. In this environment, any story suggesting that powerful institutions are pulling back reinforces existing anxiety. Confirmation bias takes over. People accept the story that matches their worries and ignore explanations that require patience. This misunderstanding spills directly into how people interpret what it means for them. For individual investors, the most common reaction is panic. Seeing large institutions rebalance can trigger impulsive decisions, selling assets too quickly, moving money without a plan, trying to time the market based on headlines instead of fundamentals. These reactions often cause more damage than the events themselves. For investors, the key reality is that diversification is not a warning sign. It is a standard principle of portfolio management. Holding assets across different sectors, regions, and instruments reduces exposure to any single risk. When large firms diversify, they are following the same logic financial advisors recommend to individuals, just at a larger scale. Risk tolerance matters as well. Every investor has a different ability to handle volatility. Younger investors may tolerate short-term swings for long-term growth. Older investors may prioritize stability and income. There is no single correct allocation that fits everyone. Copying the moves of large institutions without understanding personal goals often leads to misalignment. Another important point is time horizon. Institutional investors plan across decades. Short-term market movements rarely dictate long-term strategy. Individuals who react to daily or weekly news often end up locking in losses or missing recoveries. History shows that markets reward patience more often than prediction. For savers and the general public, these headlines can create unnecessary worry about economic collapse. The idea that one firm's rebalancing signals the end of a nation's economy is misleading. Economies evolve continuously. Capital flows in response to incentives, not loyalty. Adjustments reflect changing conditions, not sudden loss of confidence. Markets have always changed. Interest rates rise and fall. Industries grow and decline. New technologies replace old ones. Large firms constantly adapt to these shifts. This process does not mean the system is breaking. It means it is adjusting. Another overlooked aspect is scale. The United States remains one of the largest and most diverse economies in the world. It hosts deep capital markets, strong legal frameworks, and a culture of innovation. Asset managers continue to allocate significant capital there because opportunities remain abundant. Reducing exposure in one area does not erase this reality. For people with retirement accounts, the stakes feel personal. Retirement savings represent years of work and future security. Headlines suggesting instability can provoke fear-driven decisions. Shifting allocations too frequently or abandoning long-term plans based on news cycles often undermines retirement goals. Retirement investing relies on consistency, contributions over time, compounding returns, rebalancing according to age and risk tolerance. Reacting to every major headline disrupts this process. Consulting a qualified financial professional provides perspective that headlines cannot offer. Another common mistake is assuming that institutional moves are predictions rather than preparations. Asset managers do not claim to know the future. They prepare for multiple scenarios. Portfolios are built to perform reasonably well across different outcomes, not perfectly in one. This flexibility is often misread as pessimism. There is also a misconception that large firms have insider knowledge unavailable to others. While institutions have access to research and data, they face constraints individuals do not. Regulations, liquidity needs, and fiduciary duties shape their decisions. Their moves are not secret signals of doom. They are responses to publicly visible conditions. The idea that BlackRock owns all the money persists because of scale. Managing trillions creates the illusion of control. In reality, clients can move their assets, change mandates, or shift strategies. Asset managers compete constantly. Power is distributed across many institutions, not concentrated in one. Another myth is that BlackRock can collapse the United States economy through its actions. The United States economy is driven by millions of businesses, consumers, workers, and policies. Financial markets are large and complex. No single firm dictates outcomes. Even the largest asset managers operate within systems they do not control. The belief that any significant move signals a crisis reflects misunderstanding of financial dynamics. Markets adjust every day. Capital reallocates constantly. Crises are defined by breakdowns in function, not by routine strategy changes. Treating every adjustment as a warning dilutes attention from real risks when they appear. People also underestimate how boring most financial decisions are at scale. Behind the scenes, committees review data, models update assumptions, risk limits adjust. There is no dramatic moment where someone decides to abandon a country. There are spreadsheets, projections, and incremental changes. The emotional tone of online discussions often contrasts sharply with the calm language used inside financial institutions. This gap fuels confusion. When people see fear everywhere else, they assume insiders must feel the same. In reality, calm analysis usually drives large-scale decisions. Another reason misconceptions persist is the lack of financial education. Many people are never taught how portfolios work, how bonds are priced, or how risk is measured. Without this foundation, headlines fill the knowledge gap. Simplistic explanations feel satisfying even when they are inaccurate. Language also plays a role. Words like pulled, fled, dumped, or exited carry emotional weight. They suggest urgency and fear. In finance, most actions are measured in percentages and reallocations. The language of headlines transforms technical adjustments into dramatic events. Understanding this difference helps restore perspective. When asset managers underweight an asset class, they are saying the expected return does not justify the current risk relative to alternatives. They are not making moral judgments or geopolitical statements. They are optimizing portfolios under uncertainty. For individuals, the practical takeaway is restraint. Staying informed matters. Staying calm matters more. Evaluating personal goals, timelines, and risk tolerance provides a better guide than reacting to institutional headlines. Another practical point is diversification beyond investments. Income sources, skills, and savings habits also reduce personal risk. Financial security is not built solely through market exposure. It comes from flexibility and preparation. Media cycles move quickly. Stories that dominate today often fade tomorrow. Long-term financial outcomes depend less on reacting to each story and more on maintaining consistent strategies through cycles. Misinterpretation thrives where complexity meets fear. Clarity reduces both. Understanding how asset managers operate removes much of the mystery. Recognizing that large numbers do not automatically equal danger restores balance. The difference between strategy and speculation is often lost in public discussion. Strategy considers probabilities and prepares for variation. Speculation bets on a single outcome. Large institutions focus on the former. Headlines often suggest the latter. As these ideas settle in, the noise surrounding large financial moves becomes easier to filter. Not every shift deserves attention. Not every headline demands action. Discernment becomes a financial skill in itself. This perspective allows individuals to engage with financial news without being controlled by it. Awareness replaces anxiety, understanding replaces fear, and decisions become grounded in personal context rather than collective panic. In the end, the most persistent myths survive because they feel simple. Reality is less dramatic but far more useful. Big moves in finance happen all the time, especially at the highest level. Trillions shift quietly as markets change. Risks evolve and opportunities appear. These moves are not alarms. They are adjustments. A large reallocation does not mean collapse. It does not mean abandonment. It does not mean the system is breaking. It means strategy is changing with conditions. Smart money prepares. It spreads risk. It adapts. It does not run in panic. The real lesson here is simple. Headlines are loud. Data is calm. Fear reacts fast. Strategy moves slowly. Long-term success comes from understanding the difference. When you hear about massive numbers, pause. Look past the drama. Ask what actually changed. Ask why. And most importantly, ask how it fits your own goals and time horizon. Decisions driven by fear rarely age well. Decisions guided by information tend to last. Before you go, we want to hear from you. Do you think global investing is safer than sticking to one country, or does focus still matter more? Share your thoughts in the comments below. If this video helped you see the bigger picture, give it a like. It really supports the channel. And subscribe for more clear, calm breakdowns of the financial stories that shape the world around us.